Good afternoon, ladies and gentlemen, and welcome to the PCI-PAL results presentation. Before we begin, we would like to submit the following poll, which you will see on your screens. Throughout this presentation, investors will be in listen-only mode. However, questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen, or if anyone has dialed in via PCIPAL@walbrookpr.com. The company may not be in a position to answer every question received today. However, the company will review all questions submitted and publish responses where appropriate. These will be available via your Investor Meet Company dashboard. Finally, we would like to remind you that this presentation is being recorded. I would now like to hand you over to Chief Executive James Barham and Chief Financial Officer William Good. Gentlemen.
Thank you, Tom. Hello, everybody. Good morning, good afternoon to everyone that's joining. William and I are actually in the same room today, which will be nice, but hopefully doesn't pose any technical issues for us. So yeah, full year FY23 feels a long time ago now. We're 4.5 months into FY24 as we stand. Results delayed slightly, as many of you will know, as a result of the proximity of the audit to the patent ruling in the UK, which was obviously good news for us, expected good news. But FY23 was an important year for PCI-PAL in terms of building those foundations for important financial milestones in FY24. So those milestones being cash generation, full year cash generation in FY24 and full year group profitability at adjusted PBT level. And very much we've been on track for that the last 2 years. So we're expecting to achieve that. So I'm very happy with the year that we had. I would say this business has suffered a number of headwinds that have come our way completely outside of our control. And it's really thanks to the team that I've got at PCI-PAL that we've been able to deliver the year of growth that we have. So got some quick highlights for you, strategy update, financial review from William, and then a bit more on product and outlook. Please feel free to submit some questions through the chat if you'd like, and we'll try and leave some time at the end to get to some of those. So in terms of the highlights, as we said in the RNS, another strong increase in revenue. Record new business sales as well in the period. Particularly pleased about that, given my commercial background. Exceptional year for the US business, real breakout year for them, which is really important given the size of the market opportunity in the US. So yeah, all in all, very good. Revenue up 25% to nearly 15 million year on year. That's all organic growth. All of our growth to date has been organic. Exit ARR run rate up to 12.6%, only 14% increase. There's a couple of reasons for that. There's no underlying issues, just purely that our new business sales were heavily weighted into H2. So collectively, the year was a great year for new business sales, but H2 was much stronger than H1 had been anticipated. So that's reflected in the strong uplift of 23% in TACV, which is the total annual recurring revenue value of all the contracts we have signed to date, which is up to 16.4 million. The other reason why the exit ARR is perhaps not looking a bit higher than that is that some of you will know that over the last 2 years, we've been transitioning customers off of our first generation privately hosted environment. And we have succeeded in doing that. And as a result of that, some of the revenue has been lost, but actually we've retained the vast majority of the margin. And that's because we had to offer some commercial incentives to those customers to move across. However, the majority of the customers on that legacy platform that we've not really sold on since, well, 5 years ago now, majority of those were quite small customers, but that in turn had an impact on the exit ARR, which otherwise probably would have been well north of 20%. As I said, excellent year for new business ACV. So that's annual contract value. Our ACV is licenses. This is annual licenses that we have in our contracts, and we're at nearly 4.2 million, which is a 20% increase year on year. And that's driving the TACV as I mentioned. So exceptional year for the business in terms of new business sales. William will talk a bit more about gross margins, but again, we've seen those increase again up to 88% in the period. We do expect that to probably level out at some way slightly north of 90% in the not too distant future. And that's just by nature of the fact that all of our businesses on our AWS platform, vast majority of our revenues are high gross margin. It's only where we're carrying some transaction-based business that maybe will have tighter margins than the sort of 90% that you can see on the screen there. Supporting revenue growth, just on the right hand side, talk about some of the customer success metrics, and in the report you'll see we measure various things that feed up towards how we're managing things like or preventing churn. So the flip side to that is gross revenue retention, or GRR. Very happy with that, in line with management expectations at 95%. Actually, the churn related to just half of it related to just 2 customers, which are actually customers that had to leave for operational purposes, if you like. They're not using a competing solution of some sort, and one of them, in fact, we knew that was going to have to happen 2 years ago. So underlying trend really strong, given we were 3.5% churn last year. Positive NRR at 103%. Year on year, that's a drop from the very strong 118% we had last year, but we did advise investors at the time that we didn't expect to do that again in this year, in this FY23. The reason for that is because in FY22 we made a number of significant upsells to expansionary upsells, i.e. selling more of the same to existing large customers. We didn't expect to do that again in FY23, and the 103% is pretty much in line with what we expected for the year. I'm going to talk a bit more about new products later, which are really hotting up for us now, and we're expecting in this current year in H2 to be coming to market with new product enhancements and features. But really, they are going to be driving long-term NRR for us. We're clearly illustrating that we can keep customers, we can build strong relationships with customers, even through partners. We want to be able to expand those relationships through new products and services that we've been working very hard on the last 18 to 24 months. So all in all, good performance. Very happy with that. Pathway to profit in FY24 is visible to us. We just got to get the deals that we signed in the last year to revenue recognition, and keep selling across this H1 in order for that to feed through into revenue. Going to try and canter through this background. If you want more background information on PCI-PAL, please feel free to look at our previous presentations as well, because we've done a lot more on this. So fast-growing SaaS business at PCI-PAL. Effectively, what we do is facilitate secure payments for organizations across business communications environments. What do we mean by business communications environments? You might hear buzzwords like CCaaS or UCaaS. These are contact center as a service or unified communications as a service. And really, these are the communications platforms and environments that are covering interactions that customers have with businesses through call centers, or what are known as today as contact centers. So we secure data and we secure payments across all of those channels. Voice or phone is the most common, but growing very quickly are digital channels such as web chat, social media interactions, email. All those kind of touch points between consumers and businesses go through contact center business communications platforms. So majority of our customers are using our solutions in call centers today. However, we are starting to see more customers using our solutions outside the contact center, in contact teams such as finance departments and any area of their business where they're taking payments or branch networks, so to speak. Now, the problem that we solve very much relates to a compliance standard called PCI-DSS, the Payment Card Industry Data Security Standard, that governs how organizations secure credit and debit card data. And as part of that, I'll draw your attention to the fact that PCI-PAL is a principal participating organization in the PCI Security Standards Council, and we're also the only company in our space with a member of our team on the advisory board for that global body. So really important for us that we're part of that, given the market we operate in, and that's our CISO that's part of that. Key markets today are UK, where we launched, it's most mature business, North America, particularly the US, where we launched in 2018, 2019, and more recently ANZ, so in particular Australia. But as you've seen from the updates, we are doing business in New Zealand as well. Core products, Agent Assist, Digital and IVR. I'm not going to go into the detail of these, but effectively we provide secure payment solutions across live agent interactions through Agent Assist, through digital iterations, through the digital products, and then IVR is fully automated. So this is where you speak to an auto attendant rather than speaking to somebody in a contact center. So that's known as IVR. Now, We work primarily through resellers. So we have an extensive partner ecosystem that we've built up since 2016, 2017, when we really started on this journey. We are very much a partner first business, and I'll talk a bit more about the data related to that, but we've geared this business up to be that from very, very day one. We live and breathe channel in this business, and that's an example of some of our partners. Many of those are Gartner Magic Quadrant companies in the unified communications or contact center as a service markets, such as Genesys, Amazon Connect, TalkDesk. You may have seen we put out an RNS Reach on just yesterday, actually, and we've announced a really important strategic partnership with Zoom, a new reseller relationship. Zoom have an extensive business globally, and they're going at the contact center market very hard, and they're already a Gartner Magic Quadrant in the unified communications space. So we look forward to updating investors on that one in the future. And there's just some examples of some of the great brands and organizations that use PCI-PAL. In terms of our strategy, very simplistically, 3 key pillars to our strategic growth. So cloud, to be the leaders in what we do in true cloud solutions in our market. We were the first to market with public cloud offering, and we've leveraged cloud to enable us to access the breadth of the contact center market globally, and to be able to deal with any size organization in the contact center market as well. It also allows us through cloud to access the market internationally, and to do that in a cost-effective way as a smaller business. And then we're leveraging a channel-focused sales model in order to drive scale through the business. As I've mentioned, global a few times, so just covering off how we are set up as an organization, both in terms of our people operationally, but also in terms of our platform. So we've got various locations globally now. So UK, which primarily we're based out of, we've started in Ipswich, actually in Suffolk, but we spend most of our time in London now in the UK, which is where William and I are today. North America, we have an office in Charlotte in the US, and also an office in Toronto in Canada, and Australia, Sydney. At year end, we were at 114 people. We're at about 120 now. We expect to increase the headcount this year as a similar level as we did last year. So, a few more than 120 by the end of FY24. But what you'll notice is that the hiring has slowed, but that was completely as planned from our last fundraise in May 21. So we had an injection of investment into new heads, and now we're slowing that down because we've established the new functions that we needed to, and we're going to start realizing the operational gearing through that. Now, supporting our kind of holistic view to where we have our people is our AWS platform. As you can see from the orange padlocks on screen there, these are the AWS instances that we have available. We can spin these up extremely quickly. Within one day, within a matter of hours, we can have a new instance live pretty much anywhere in the world that AWS has a presence. But primarily today, that's focused across London, Dublin, Frankfurt, and then we've got we've got 2 in US actually. Now there's a new one needs to be added to that, Toronto, and also Sydney as well. Now, in terms of new products, a bit more on that to come later, but on the sort of right-hand side of that slide there at the bottom, you can see that we've launched an enhanced speech recognition offering in the second half of FY23. It really is a big step forward. So we've had speech recognition capabilities really to deal with exceptions. So customer accessibility issues through our Agent Assist solution, but also to use it in our IVR as well. But actually, we've moved to an offering which we've integrated so well and using such good technology that the success rates well exceed 90%. So we're actually now seeing some customers looking to use speech recognition as the primary data capture mechanism, as opposed to keypad entry. So that's a really interesting development that we're enjoying talking with customers about, because we're giving them that additional choice. One thing I didn't mention was on the platform maturity. So as I said, we were the first to market in 2017 with our public cloud platform. 5 nines uptime reliability, as you can see in the pink box there. Pretty much 100% across our H2. So really stable platform from which we can grow from. We can layer on products and services as well. So very happy about that. The green rosettes, by the way, are patents. That's where we've got patents. We tend to just patent things that we think are ultra innovative, and to protect the unique ways that we do things, particularly related to the way we integrate cloud to cloud, particularly how we integrate to voice flows, cloud to cloud. And our most important patent has been granted across all the territories that we cover and more. So we do use that to protect our relationships with our partners, as the leader in cloud solutions in our space. And I'll move to partners now. So in terms of the update on our partners, we break them into 3 categories. I'm not going to get too deep into that on this call, but I have done on prior calls, but you can see that on the slide there. The majority of our partner deals come through our integrated partners. So these are partners that we generate tight-knit, repeatable integrations with. So once we've integrated with them, they can sell us and repeat sell us, and the operational effort is quite minimal. We typically expect to do somewhere between 75 and 90% of contracts through partners. So really in the year, the sweet spot in the top right there, 85% of contracts through partners was exactly as we'd expect it to be. The big trend change, I suppose, which is entirely expected, is that we're seeing more value coming through partners as well. So more ACV value coming through, which is really a sign of the depth of the relationships that we have with these organisations that we've built over time. I've been telling our institutional investors this week when I've seen them that we have not lost a single global partner relationship. We've only ever retained these relationships and made them deeper. You know, you get the odd road bump along the way, but actually we're very good on a relationship basis with these partners. So it's sort of no surprise to me to see that the value of contracts coming through partners is increasing up to 77%. And directly, that's as a result of those partners trusting us more with their enterprise customers. So we're seeing, historically, we may have done some enterprise deals direct. We tend not to do that anymore. We tend to be able to fulfill them through our partners. And yeah, we're continuing to invest in that side of the business. Okay, and then just to round off before I hand over to William for the financials, as some of you will know, we've had an ongoing patent litigation lawsuit going on at PCI-PAL. If you'd like more background, I would suggest probably the best place to go is to read the last couple of years' financial accounts, or the half-year accounts as well, because we've given extensive detail. The summary on this call is really strong victory, as expected. So, we've been very confident throughout, and I think that this ruling very much validates the management and the board's position on this. And it validates our view that this has been brought by a competitor to try to disrupt this business. The judge ruled that the patents were invalid for several reasons, not just one. So we won on pretty much all of our counterclaims that we made, but the judge also ruled that even if the patent had been valid, we wouldn't have infringed, and neither would any of the changes that we submitted that we could make in a worst case scenario. So this really was a strong outcome for us. We absolutely will be seeking a maximum cost order when we go to the form of order hearing in the UK in front of the judge mid-December. It's the 18th and 19th of December in London. And I think the view of the board now is really that the downside risk, or the downside risk perception, should significantly be substantially reduced for investors as a result of this kind of validation that we've seen through the ruling. The US side of the case continues, but the US side is fairly similar, and in fact we've got more that we can go at in the US. So we will continue to fight this position very hard as we continue to drive this business forward. So William, I will hand over to you.
Good afternoon, everyone. Thank you for attending. It's much appreciated, the support we get from our retail shareholders as well as our institutions. So just turning to FY23 results, we've had a strong year. We managed to achieve targets. Revenue continues to grow strongly. ACV is a record period for the period, and EBITDA is decreasing as planned. And we've won the patent, as James has just been describing. Which, the patent case has been a distraction, and we've also been facing the stronger headwinds of higher inflation, higher interest rates, which has clearly had a slight dampening effect on the market, but we've still managed to deliver what we said we would deliver. Just turning to the results, looking at the top left-hand graph, this just gives you the history of where we started from actual recorded revenue. So back in 2018, when we launched, it's financial year 2018, when we launched the AWS platform, we were a tiny business with 20 people, turning over £2 million. So over the next 5 years, we've managed to deliver strong sales, embed our AWS platform, and we just recorded £14.9 million worth of sales for the year. And FY24, the current city forecast is 19.1. So you can see the momentum that's been building up. At the same time, we focused on our gross margin. Back in 2018, our platform at the time, the Gen 1 platform, which I'll talk about a bit more in a minute, was a revenue share, so 50-50 margin. We own our AWS platform, we develop it all in-house, and as a result, the more and more we sell on it, the stronger and stronger our margins are getting. I'm expecting our margins to peak out at around 90-92%. It depends on the sales mix we've got clearly, but that's quite roughly where I'm expecting it to peak out. On the left-hand side, those graphs up there, there's a commitment from James and myself. We've been growing the business, we've set out on that ambition, we've been supported by our shareholders through 3 fundraisings and the proceeds of the sale back in 2016. We spent about £20 million developing this business, but it's always been our ambition to build a global business. So we've gone from 20 people to 120 people currently. That costs a lot of money. We've spread out into the US and around the rest of the globe. But at the same time, we've got a commitment that not all revenue will be spent on costs and growing the business. Each year we look to put to put some back to the shareholders at the end, and you can see that on the adjusted EBITDA line, and you can see that stepping down. And we're expecting to hit roughly EBITDA break even in the first half of 24, and we're targeting a full year break even small profit in FY24 at adjusted PBT level. So PBT is just taking out the cost of the exceptional cost of the patent case. So we're growing strongly. Our revenues have grown compound rate since 2018 of 48%. The EMEA business recorded £10 million worth of our sales. That's up 18% in the year. North America is growing more strongly. Why is that? Well, the actual contact center market over there is 5 times the size of the UK business. We're selling more and more in that region. ANZ is growing, but we only launched there last year, so it's going to take time to build that momentum. And it's a lot smaller market, but it's going to be a footprint we believe into the wider APAC region. So all in all, we're well placed to achieve our FY24 targets and hitting profitability. Just looking a bit more on sales, on the top left-hand side there, the graph there, you can see our progress in new ACV sales. These are the contracts we sign each year, and it just relates to the recurring revenue that's embedded in those contracts. And as you can see, it's stepping forward as we get more and more momentum with our partners and more brand recognition within the market. That ACV then feeds into TACV. TACV is the pile of contracts we've got in the building. Not all of them are live, and I'll talk about ARR in a minute. There's always a delay between signing and go live. Our typical time to go live is around 5 to 6 months. So as at the end of the year, because we have such a strong second half in sales terms, we have quite a lot of contracts in deployment at the end of June. We had £3 million worth of contracts in deployment as opposed to £1 million in the prior year. Those contracts will feed through into ARR, as James described earlier. So ARR is our measure of the value of the live contracts as at the point in time. So that has grown to £12.5 million, £12.6 million at the year end. Now, why are these slightly higher? Well, two reasons. Our Gen 1 platform, it was the original platform, and we decided to shut down the payment element of it during the year. That cost us £500,000 in revenue. So if we had kept it going, our growth rate wouldn't have been 25%; it would have been nearer 30%. But in shutting it down, we've taken £500,000 off our recurring revenue and off our TACV. So that's lowered the TACV down from 17 million down to 16.5 million. and our ARR on the same sort of measure, it would have been around 13 million. However, we kept the margin at the bottom line, so no impact to the business, and it's good housekeeping because we've managed to take out another platform that doesn't meet PCI compliance. The other thing just to note, our TACV, we reset the exchange rate in both the ARR and the TACV at the end of each year. So at the end of the year, the US dollar rate was 127, having been as low as 112 in the year. That took another £400,000 or £500,000 of our TACV and about £300,000 of our ARR figure at the time. So those numbers you see there give you a reflection of the true position of what we have coming into the market, into the FY24. As James has already said, customer retention rates remain excellent. It was 4.6% churn, so 95.4% gross retention. And as James said, half of that came from 2 customers, one of which was NHS Track and Trace, which I can name because obviously no longer needed because of the COVID pandemic restrictions being relieved. NRR remains positive. So on our current product set, we expect to sell between 1 and 2 times what we lose in churn. So if our churn is 5% on the ARR, that's £600,000 a year. We would expect to sell between 600 and 1.2 million in upsells to our existing clients. We achieved 1.5 times, so it's well within our expectations. Just moving on to some other financial highlights. Just a reminder on that top bullet point, people are our biggest cost within the business. We do everything in-house. We don't outsource our developments or anything like that. So my cost base of the administration cost base, 78% relates to people and people-related costs, leaving 22% within the other bit, for the rest of the overhead. So that 22%, you've got about 7% equates to our running the AWS platform, which we treat as an overhead, not as cost of sales. Why is that? Because that AWS platform includes all our development, staging, and test platform, and the cost for that was pretty stable in the year. Our next biggest expense after that is marketing, and that spend was about 6-7%, and then the rest is covered across normal other bits and pieces running a business like offices and things like that. Just turning to the patent case, clearly it's an unwelcome financial distraction. By the end of June 23, we had already spent some £2.7 million or received invoices for £2.7 million in defending that case. Jump to today, I'm at around £3 million. The one thing to note within our numbers, if anyone's looked at the results, we received in the year nearly £2 million worth of invoices, but a lot of that was back-end loaded in June because the court hearing was in June. So I came into the year with about £800,000 worth of unpaid patent-related costs. Now those have all been absorbed in Q1, and so nothing to worry about. But that's just needed pointing out. We've obviously won the UK case, and as James said, there's a form of order hearing in December, and we're pushing to have UK costs awarded there and then. Clearly, that's at the judge's discretion. And so we will take and listen to her observations. We are hoping for a cash refund on our expenses because we've spent heavily, but all our plans do not include receiving anything up front currently. So what's happened to our cash flows? FY23 was predicted to be the last year where we've been investing in the business and have negative cash outflow. So we spent £3.6 million in the year, of which 1.3 million related to the patent case. 2.4 million was spent running the business. Now, if you look at H2, we actually generated from operations £200,000, excluding the cost of the patent case. So that shows our business is growing. It also shows that H2 is slightly stronger than H1. Now, we did receive a fillip from one of our customers who paid 3 years in advance up front. It's a big American company we have. So that generated an extra $1 million, so circa £800,000 in additional cash coming into the business. However, we had a delay in our R&D tax credit of £550,000, which we were expecting to receive in Q4, but it actually got bumped, and we've now received it in Q1 FY24. So those two kind of offset each other. So we would have been cash positive even after those adjustments. So we finished the year with £1 million worth of cash and an undrawn HSBC facility. Now, with the cost of the patent case, I have spent that cash, and we have drawn down in the first couple of months on the HSBC facility, but I'm now back in a position of net cash. And as we head towards H1, which is only 7 weeks away, believe it or not, we're expecting to be back into a net cash position. So happy to take any questions on the chat as they come through if you want to ask them. But in the meantime, I'll hand you back to James.
Okay, thanks, William. Yeah, I've been keeping a note of the questions coming through, so we'll try and get to as many of those as we can at the end, and if not, we'll submit responses in the portal as well, written responses. So just onto product, just briefly before we wrap up. So in May 21, which was the last fundraise we did, we raised that for a number of reasons. Primarily was to expand further globally, invest a bit more into the US, expand the business into Canada, ANZ, but also a big part of it was to raise capital to invest further into growing our engineering and product function within the business. And we've been doing that. I mean, we made a fairly cautious start to it because we think that's what investors wanted following the raise in 2021. But we've been moving that forward and getting very close in coming up to the end of H1 in FY24 to actually releasing some of this stuff to general availability. So it's just a bit of a reminder in terms of where we're coming from and going to. So the investment in engineering and product was very much timed to align with the successful execution we've had against our strategy. So as I indicated earlier, our 3 key strategic pillars of cloud, access the global market, and channel partners, we've done very well there in my view, and as such we've got a very strong market position in our space globally, and we've got a global cloud platform that's seriously reliable that we can now iterate upon. We can build new products, new services onto that with a view to trying to drive that out into the existing customer base for upselling and cross-selling opportunities, but also to enhance our opportunity both in terms of new business and also longer term looking to grow our addressable market by entering new areas as well. One area we've talked about a lot is payments. So today we're very focused on security and compliance, but really security and compliance is becoming table stakes of what we do, and we're driving the value proposition more towards customers generating more revenue, controlling their costs becoming much more relevant today. And we're bringing a lot of the really interesting digital payment methods that we've seen across e-commerce environments to the sophisticated omni-channel communications environment as it is today. I appreciate this is not the most exciting update on product for investors to see. We are not quite ready to go out to market yet with snapshots of what these things actually look like, though we do have the majority of this in minimum viable product stage, which is MVP stage. We have new customers that have been signed to these, but we're running it through a very proper product management process, which is a business we're now able to do with a strong product function within the business. But the sorts of things that are going to be coming to market literally in the coming months and across FY24 are a completely new look and feel to the user interface, both from a consumer perspective, but also in terms of agents as well. Included in that as well, new reporting interface and data analytics as well. We're bringing digital wallets to all of our current offerings that we have today. So not just able to take credit and debit cards, but also incorporating all the digital wallets, the main ones that are out there, Apple Pay, Google Pay, etc. We've got embedded integrations with buy now, pay later vendors. So buy now, pay later being the likes of Klarna or Affirm in the United States. And I say embedded because these are really tight-knit, repeatable integrations that we've got. We've been able to deliver services for these things for a number of years, but they would require custom projects. What we're looking for is high repeatability of these sorts of services that we're delivering, so that in the long term we can scale quickly and we can have these things live and running for customers in a very short period of time, more typical with what you'd associate with a true SaaS offering. And then we've also got the new fast start payment processing option in play for small to medium-sized businesses, a partnership that we've put in place with Stripe, and we have signed our first customers to that as well. So we're actually getting a piece of the payment as it goes through. So one of the aims we have for this year, and certainly it's a personal goal of mine, is that by the end of FY24 we would have rolled out and have our top 5 partners today live with these new product features and this new offering. So that's really only 6.5 months away. 7.5 months away. But we'll try and get it done in 6 months if we can. So we really will have a very new look and feel to our products in the next 6 to 9 months' time, and that's really exciting to be part of. And our team have done exceptionally well to do that. On the right hand side of that slide there, you can see as well that we've mentioned, and we did start to talk to investors about this, we're developing our own artificial intelligence capabilities through our roadmap. These are more likely to come at the back end of FY24 through into FY25. Everything we built today is really focused on driving more availability of the data, so that we can therefore off the back of that analyze that data, and we can do intelligent things with it. So particularly around customer experience and the touch points with payments as that's going through, gaining more insights so that we can, in an automated fashion, go back to our customers and give them recommendations on how to increase revenue, reduce costs, reduce handling time within contact centers and these sorts of things. And we're doing that in a completely automated and intelligent fashion. So a lot of momentum being built up in the background here, but it's all off the back of the additional investment that we made following the fundraise in May 21. It's all as planned. Just wrapping off before questions on the outlook. So we're expecting to accelerate revenue growth slightly in FY24 to 28 to 30% revenue growth. We're expecting this year, as we've said, to be our first full year of cash flow positive, to be our first group profitable at group level, so adjusted PBT level. Expect to be, well, we might be EBITDA profitable at the half year. We'll see. Depends. We've got a few things to fit into that. But yeah, full group profitability the full year is what we're aiming for. I've talked about the top 5 partners and the new product launches that are going to be coming. And of course, when they do get launched, we'll probably be pushing out some financial PR around that as well through perhaps RNS Reach. We've got the UK form of order hearing for the patent case, so we're looking forward to that. And we let the US bit just run on, having done a lot of the heavy lifting now. Very confident in our position there. In terms of sales highlights, I mentioned earlier about Zoom, so that's happened since the year end. So that's excellent, and we're really advanced in that, by the way. So we're already working pipeline with them, and that's expected to be fully live at product stage in just January. So month and a half's time. So good momentum in the US for new business, and high engagement levels from our partners, particularly around our new products that are coming through. So I think that wraps up the main slide deck. So we'll get to some questions.
That's quite a lot of them.
There is quite a lot. So and some of these were submitted in advance as well. So we won't be able to cover all of these, though we do have a fair amount of time. So I'm going to try and group some of these together as well. So if perhaps I'll cover the patent question first, of which there's been a few. So I'll try and bake these all together. So given the victory in the UK, do we think there's a material risk from the US from the US side of the case? And also, can we talk a bit about timing of the US side as well, when we expect to get to trial in the US? So answering both of those, yeah, I mean, confidence is high, our approach validated, and the US case is very similar. So there's absolutely no reason for that confidence of ours to flow into the US case. We've learned a lot through the UK case, the result. There's more to go at in the US as well. We do intend to invalidate these patents, given where we've got to with this. So not only prove that we don't infringe, but invalidate them as well. I mean, as you can imagine, as directors of a publicly listed company, be it a fairly small one, we've been very thorough in preparing for 4 trials. So even though we were confident, we prepared for every potential outcome and had a way forward with any of those. So we continue to have those plans if we need them. We don't think we'll need to make any changes to our solution. We don't think we'll need to take a license in the US, but we are prepared for those things if we absolutely need it. So in terms of material risk, we believe it's substantially reduced, and I think it's highly unlikely that anything that happens in the US is going to prevent this business continuing at the momentum that we expect it to. In terms of timing, I think we're expecting the US trial to probably not be until maybe autumn next year, perhaps the summer if we're lucky. We do want these things to happen as soon as possible. Another question was, can the other side appeal the UK? And if so, what's the timeline? My understanding is that the timeline is they have 21 days following the form of order hearing. So form of order hearings mid-December, so that would be January. And then I believe that an appeal hearing is probably going to be 6 to 9 months from that point. And preempting another question, which has come at us from other investors, yes, when we win the appeal, we would expect to get the majority of our appeal costs back, as well as other costs that we're seeking in the form of order hearing. A couple of individual questions I'll take. I don't think there's many here for you, actually, William.
No.
I'm afraid. Do we invoice our partners? Sorry, do we invoice our customers directly, or do our partners invoice those customers for us? So we invoice direct customers directly, of which there aren't a huge amount these days in terms of new that we sign. The vast majority of our partners are resellers, so they're signing business on their paper. So our partners contract with the customer, and we have a reseller agreement with the partner. In terms of invoicing, the partner also invoices the customer. So we give a wholesale rate, which the partner then marks up to their customer. There's a question on profit, which is you expect to get to full year profitability this year. What are the things that could prevent that from happening? I think we've covered some of this to a degree. The main things we're sensitive to as a business are really timing related. So in order for us to get to revenue recognition, which clearly is required for the revenue to move forward and profits come through, we have to get our services to that revenue recognition point once we've sold them. And typically that runs at between 4 and 5 months when we've sold. So we've got a lot of stuff going through deployment at the moment. We never lose these things. They just sometimes can take longer than expected. Often they can be dealt with quicker as well. So that's one aspect. And the other aspect is H1 sales. So really we're getting to the point in H1 where new business sales in this year are not going to contribute very much to FY24 revenue because of the nature of the way that the revenue's released. Is that good enough from a finance perspective, William?
Yeah.
So,
not honorary accountant.
Yeah, it's just the easiest way, isn't it? Sales cycles. Have we seen any? What was the wording? Have we seen any impact on our sales cycles given the current climate in the tech market? We're watching it closely. No doubt, there's a lot of talk in the tech vendor space that deals are taking longer. I've seen some of our competitors make the same comments as well, and it's more hard work pushing deals through contracting processes, certainly, particularly with big companies. So yeah, we're seeing it anecdotally in terms of the data. Our sales velocity in FY23 was 120 days. So that's from when the opportunity comes in to when we close. It's tracked up a little bit in this first Q1 that we've just been through. It is a backward-looking metric. So I'd say it's going to track up a little bit, maybe 10 to 15%. So key is having a strong pipeline. Is having pipeline that can move in to replace through backfill any deals that move out. And I'm pleased to say that our pipeline looks very strong at the moment, and our partners are really working well for us at this point. There was another question related to the patent, which was, given the amount of legal fees that you've had to spend out of ordinary cash flow, what impact had that had on the plans you set out to investors in 2021? I think we have to be careful what we talk about here. We do have an active court case going on, and so I will be cautious about what I put out there publicly. However, something we have been forthcoming with investors is that part of that fundraise related to our mainland Europe launch. Actually, that was the main thing that we pulled back on to conserve cash to deal with this sort of unwarranted claim against us. Unfortunately, it does require those funds to do that. So we're in FY24 now, and actually we should have been in a position of having several sales heads in mainland Europe up to speed for probably at least the last 12 to 18 months. So yeah, that does put some pressure on new business sales momentum, but it's not a permanent thing. You may have noticed in our accounts that we've said that we are actually going for the full launch again in mainland Europe at the back end of FY24. So we are doing that. And in the meantime, we've had a kind of interim solution that we put in place. We've got several people in the UK business on the sales and PS side who speak multiple languages. So we've been able to leverage that. So, but we're going to be more proactive in the second half of this financial year, particularly with our partners who have pretty extensive businesses across mainland Europe. So that's one we can really look forward to. It's been a frustration, but we're now really looking forward to getting stuck into that. I don't think there's any further questions that we're going to take live on here. There's probably been a couple come in. No.
Yeah, no, I think we can address the other ones, outstanding questions online, can't we? So, yeah, great. Okay, well, look, thank you, James. Thank you, William. Appreciate updating investors. Could I ask investors not to close this session, as you will now be automatically redirected for the opportunity to provide your feedback. If anyone has further questions or would like additional information on PCI-PAL, please do get in touch via pcipal@walbrookpr.com. Many thanks for attending today's presentation.
Yep. Thanks, everybody.
Thanks,
Bye.
everyone. Bye-bye.